Welcome to Getting Our Reward Heads Together, the podcast for HR and reward leaders navigating the challenging world of reward. We bring you insights from the Reward Heads team and key partners to help you develop practical strategies to deliver reward that enables you to recruit, retain, and motivate in a fair way. Reward Heads are a boutique reward consultancy working with organisations of all sizes and sectors on solutions bespoke to them. Now, on with the podcast. Hello and welcome to the latest podcast where we explore the big issues in reward. I'm Victoria Milford, CEO at Reward Heads, and today we're looking at the government's plans to payroll benefits in kind rather than have us do an annual P11D for employees and the implications of that. So Reward Heads carry out regular benefit reviews, but we know our limitations when it comes to tax advice. And so I'm joined today by Ian Goodwin of Forvis Mazars. Hi, Ian.
Hi, Victoria. Lovely to be with you today. And thanks for asking us to talk on this topic. As Victoria said, I'm from Forvis Mazars. I'm a partner in the employment taxes team. So I help people with tax problems across employee benefits, payments, expenses, etc. And I'm part of the global Forvis Mazars team. We have over 4,000 employees in the UK, and we like to help our clients as best as possible.
Brilliant. So that bodes well. So the idea of payrolling benefits in kind, it's not new, is it? It's been possible to do it voluntarily, hasn't it?
It has, yes. You can voluntarily elect to payroll benefits by going on HMRC's website, clicking into their portal and submitting an application to payroll benefits. Providing you do that before the end of the tax year, you can do it from the next tax year. So say if you wanted to do it from April 2026, providing you did it by the 5th of April 26, it would go live from the 6th of April 26.
Got it. So why are the government and HMRC doing this now, making it compulsory now, I suppose I mean?
There's an official answer and there's probably some unofficial answers as well here. So to give an official answer, payrolling of benefits is going to be made mandatory to modernise and simplify the UK tax system by allowing benefits in kind to be taxed in real time through the pay-as-you-earn system. Now, that is the official answer. And, it makes a lot of sense. What they're trying to do is really digitise benefits. There was a big change to obviously payroll with real-time information a number of years ago, and they're trying to do this with benefits now, so they can get tax in more quickly. They can hopefully reduce non-compliance, and they can get all the benefits and pay to be more transparent for individuals too. But the onus then is really to collect tax more effectively, efficiently, and to reduce the administration associated with it. And that will also be the case for the national insurance too, because there is Class 1A employer national insurance on benefits. And that's something that would then also be collected through the payroll, they hope, on a real-time basis, i.e. weekly or your monthly kind of sessions that you'd have there, rather than just annually in July every year after the end of the tax year.
Okay, so I think one of the things that I always found a bit more difficult when it comes to sort of P11Ds is starters and leavers, because unfortunately they don't start and leave on the start and end of the tax year. Would it make it easier to deal with them?
To some degree, yes, it will help a little bit, because if you've got a starter and say you've elected to payroll benefits from April 26, you've processed your document to HMRC, they've accepted that you're going to payroll medical insurance. Let's say you've got a starter that started in that tax year where your payrolling benefits say they've come in June, for instance, rather than the start of the tax year. You would then be able to payroll that benefit straight away for them. If they've left and you payroll the benefit, they would just drop off. So say they leave in a month, say they leave in the December of the year, you would stop payrolling it from the January because they wouldn't be on the payroll anymore. And you might need to make some adjustments, and you could do that through your full payment submissions throughout the year to make sure it reflects accurately. So to some degree, there's probably some efficiencies there with it. But obviously, instead of doing it just once with a P11D, you're doing it 12 times potentially if you've got a monthly payroll, or on a weekly basis, which would be even more times to look at. So you do need to consider that. And for some organisations where they've got lots of starters and leavers, that will be a big concern for them to payroll benefits, to think, well, actually, we've got to add them to it. Do we know what benefit they've got? do we know what the value of that is, and can we easily then put it through the payroll system? Whereas at the moment with the P11D process, it's really once a year, and you're reconciling after the end of the tax year, so you've got a bit of time to breathe, digest, and then report.
Okay, well, let's start with what we already know. What will employers need to do, and when?
Well, at the moment, they don't need to do anything if they don't want to payroll benefits. The government were looking to implement payroll benefits on a mandatory basis from April 2026. However, they deferred that recently. That is now going to be from April 2027. So in essence, we've got P11Ds for a little bit longer now. We've got to get through the 25-26 tax year and the 26-27 tax year with P11Ds, should employers want to do that. They can still elect for the April 26 year if they want to do that. But if you don't do anything, and subject to the guidance still being relevant when we come to April 2027, you wouldn't need to register. You would just start payrolling benefits in April 2027 for all your workers that are provided with taxable benefits in kind. And that's the taxable benefits in kind. So it's your medical insurance, it's your company cars, it's your dental insurance. It's those types of things that you'll be doing it for. It is important to note, however, that there will be some benefits that you will not be able to still, on a mandatory basis, payroll. You would still need to voluntarily elect to report them through payroll from April 2027. And that will be your beneficial loans that are taxable, and also accommodation. And the government are looking to see what they need to do around there. So they're taking views from lots of professional services firms, from professional bodies, from observers in the market, from payroll bureaus and things like that, to make sure they can think about that and get to a good answer. But it may well be that that's something that still sticks on like a pseudo P11D post April 2027 for some organisations that do not wish to voluntarily elect.
What about salary sacrifice benefits then? Because an awful lot of employers have got those. Are those treated differently?
Exactly the same. Salary sacrifice. So salary sacrifice is it's a reduction in pay. So it's a negative pay item that you would typically see on the left hand side of a pay slip. So it may be that a lot of employers have electric vehicle salary sacrifice in place now, and they would see that actually if someone wants, say, Tesla or a BMW or a Mini or whatever like that, they would sign up through their portal. They would then get an amount that's going to reduce their pay every month. So it might be, say, I've signed up for a car. It's going to cost me £500 in gross pay a month. So a minus £500 figure will still be shown on the pay slip. What will happen with payrolling of benefits? That vehicle, instead of it being reported on a P11D, you'll see a positive notional pay element on the pay slip that is the same value on a prorated basis as the benefit in kind would have been on the P11D.
Okay. I think my brain's hurting already, and I think I'm going to make it worse. What are OPRAs? They sound very glam.
Yeah.
All I know is it stands for optional remuneration arrangements. Is that the same thing as salary sacrifice?
Yeah, it's part of salary sacrifice, really. So it's when they were hardening their stance on salary sacrifice. HMRC did this in 2017. And what they did is they looked at certain salary sacrifice arrangements and said, are they too advantageous for people? So one of them was car parking, for instance. If you provide car parking without salary sacrifice at your place of work or near to it, to your workers, it's not taxable. But if you do it through a salary sacrifice arrangement, now that OPRA's in place, it will be taxable. And the taxable value will be equal to the higher of the salary sacrifice taken or the taxable value of the benefit in kind. So with car parking, for instance, because it's not taxable outside of salary sacrifice, the higher value would be the salary sacrifice value there. So in that example, what would happen, because that's caught by OPRA, is you would have a salary sacrifice value still shown on the pay slip. So that reduction, that negative pay element for car parking salary sacrifice, but then you would also have a positive notional pay element that would otherwise have been reported on the P11D for that benefit because it has become taxable through OPRA. There are other benefits that you think about. So what else is caught by OPRA? Well, company cars that are not kind of seen as carbon efficient, so ones over 75 grams per kilometre is still the rule, whereas electric vehicles are not caught by OPRA, but they're still a benefit in kind. You've still got to report them on a P11D because they have a percentage value attached to the list price. So that's something just to be mindful of. So if it's still a petrol or diesel car, hybrid vehicle that's over 75 grams per kilometre, you'll have to think about OPRA where you've got salary sacrifice. And what would then need to be reported as the benefit that's payrolled would have to be the higher of the salary sacrifice or the company car taxable value, the list price times the CO2 emissions percentage. If it's not caught by OPRA, you'd just be reporting the company car benefit in kind, right, the list price times CO2 emissions, but you still have the salary sacrifice to put through the payroll. So there is a little bit to navigate there. It's just understanding where your ducks are and you've got them in the right rows.
Yeah, absolutely. And I know you know that we have a bee in our bonnet about national minimum wage and how easy it is to get caught out on salary sacrifice benefits. So this isn't going to be any different. And no, because they're not. It's I think I get it.
The important thing with minimum wage will be making sure, and it sounds probably quite simple this, but it's again, because there's lots of complexities with payrolling benefits, is making sure you've identified your pay types that impact on minimum wage. Mm-hmm. So you're quite right, Victoria, there. So if you've got your normal salary, you've then got your salary sacrifice, which reduces your pay for minimum wage purposes. And then you've got a notional pay type, say the benefit in kind, the medical benefit. You don't take that into account for national minimum wage. It'll be ignored because it's not pay, it's not cash. Yeah. It's a benefit. So you need to make sure your payroll system is set up sufficiently to still monitor NMW on the right pay elements.
So you mentioned cars a minute or so ago, and I guess for most people, that's the biggest taxable benefit that they have. So how do we work out what we need to payroll? And I know something that comes up all the time. What happens if we change mid-year? Because again, people don't change their cars on the first day of the tax year.
That's a great question. It is, I'd say, a major weakness we've seen with people that have elected to voluntarily payroll benefits and they've got lots of cars, because people do change their vehicles. Someone might have a crash and have an emergency vehicle for a period of months. They might just change their vehicle quite a bit because that's what the organisation does. So you need to be really mindful that where you've got where you've got a company car policy, where you've got people with company cars, you still need to work out the value based on the list price times CO2 emissions value. So that will give you, say, an annual value over the tax year. You would then need to prorate that for the 52 weeks or the 12 months or whatever pay period you have to work out a taxable value for each pay period. If then you change vehicle, you need to do that again. But I suppose the beauty of payrolling benefits to some degree is that you can vary this each month. So if you get it slightly wrong, you can just update it for the next month. As long as overall you're right for the entire tax year, you can continue to make adjustments so it's correct by year end. So that's something to be mindful of. But obviously, if you're flipping from an electric vehicle that's very tax advantageous to something that's a heavy diesel car, you're going to see a big change in the taxable value. So one thing you'd need to watch out for there is whether you can collect all the tax through the payroll or not. Because there's this thing called the 50% overriding limit, where you can only take 50% of someone's pay in tax. And in that case, you'll have some interactions with self-assessment and assessment outside of the payroll. So there's a few things to consider there where you've got variations in vehicle and for people to really think about and for employers to communicate clearly.
Yeah, I think there's a bit of reassurance in there somewhere. Again, coming back to my national minimum wage point, where you have to fix things in the next pay period, don't you? Whereas it doesn't sound like that's going to be the case. As long as you fix it, well, ideally by year end, then that's okay.
Exactly that. Yeah, as long as you've fixed it by year end. You could have, for instance, someone's got a new vehicle every month, and you think, well, that's a lot of change. And there might be different taxable values then when you do the prorated calculation. So it might be 1 month, it might be £500, the next month it might be £100, the next month it might be £2,000. But as long as overall you've reconciled it and you've had the check-ins, then you'll have been compliant. You'll have paid the right amount of tax and you'll have paid the right amount of Class 1A national insurance on those vehicles that were provided during the tax year.
So I've heard of making good. You might need to explain what that actually means. And I'm thinking that private fuel benefit is probably an obvious one while we're still talking about cars. So what would need to happen and by when? And what if it doesn't? What if people don't repay the private fuel?
Right. Well, private fuel is a big benefit in kind value if you've got a company vehicle, because it's based on a fixed amount plus the CO2 emissions percentage, basically. So it can be a significant figure and a lot of tax to pay. And it can arise where you've only done one private mile or made it available for one private mile. So it's like, wow, that's a lot of money. So you're right. A lot of people choose to pay back that benefit. Now, most employers in that case, if they know the employee is paying back that benefit, you wouldn't report it on the payroll at all, the payroll benefit, because it's not a benefit in kind because it's being paid back. If you're unsure it's not being paid back, though, you would need to report it through the payroll. And if it is then subsequently paid back after the end of the tax year, because at the moment you have until the 6th of July after the end of the tax year to make good benefits for the last tax year, you would then need to do adjustments through the payroll to make sure that's then covered. So this is one of the areas where we're going to have to get some better and more clearer guidance from HMRC, I feel, as we get through the autumn and winter period and as payrolling of benefits gets nearer, because that's something that people are going to be more interested in. Separately, you might also provide private fuel to drivers that don't have a company car, that have their own vehicles. That's calculated differently to company car valuations of private fuel, because that'll be based on the actual cost of it. And you need to be really careful here. So is it something that should have been on P11Ds and now needs to be payrolled? Or is it something that always should have been payrolled because it wasn't really a P11D item? And that's one of the nuances you need to look at on how they've been provided to your employees. And it's something we do have regular conversations with HMRC about during compliance reviews.
There is such a lot to think about on cars, isn't there? I can see the temptation of just giving a car allowance now. I think that a lot more has gone on the pro side of that. Because the other one that I was thinking about was, if employees have a low pay in a given month, because you mentioned the 50% maximum tax. So say you're off on maternity leave or something and you've still got a car. How does that work? How does that get payrolled as benefit if you're not on full pay?
Well, this 50% principle would come into to play then. What you'd need to do and what would happen is it would still go through the payroll, but you wouldn't be able to take all the tax through the payroll. The payroll software should stop it. Let's say the Class 1A national insurance is taken on a pay period basis. So let's say it's a monthly pay period. That would still be paid based on the full rate because that's an employer obligation. But the revenue would catch up with the individual through self-assessment or through a simplified assessment after the end of the tax year for the amount of tax they owe. So this is one of those areas that's going to have to be communicated quite transparently to employees for these types of scenarios where you might have people that go off on statutory leave for whatever reason, whether it be sick pay, maternity, shared parental, whether they, go AWOL for a period, whether they've got jury service, all these types of things can come into play here. So it's definitely something to be mindful of. Yeah.
I think my brain's whizzing around all the but what ifs. So another one that I was thinking about was, what if somebody leaves and they have no more pay from us, but they maybe retain their benefits for a month or two. So I'm thinking something like they still have their private medical because they might be undergoing treatment. So how would that be dealt with? Because they're not an employee anymore.
Well, again, a good question. It's something you would need to look at in a bit of detail from a tax perspective. So has that benefit been provided as part of a termination package post-leaving, whether they've kept the medical benefit for a period of time because that's been negotiated as part of the termination settlement, whether an asset's been transferred over to them on termination. So that's where we might need to do a mixed termination report outside of payrolling benefits to HMRC, because they've got over 30 grand when you add up the cash value of their termination payment plus the non-cash value. Say they've got the medical benefit for a period of time, or they've been told they can keep the car, for instance. We regularly see that. Separately, if it's under 30 grand, we'd need to think, well, is it tax free? Because actually it's just part of a kind of negotiated termination package. But then if it's not, would we need to report it? Some of the HMRC guidance on the current manual that's looking at this area suggests that you collect any uncollected amounts through the full payment submission. So you'd still have them on as a lever on the payroll system, but they probably have a 0T code then and be month one or week one for national insurance purposes. But obviously it's Class 1A NIC, so it won't affect the individual in that sense. So there's, again, something still to work through here, I would say, for some clearer guidance. But those are the types of things I've been talking about with my clients. It's the types of things we do now when we're looking at whether the benefit needs to be reported on a P11D post-leaving, because they're not an employee. So how can you provide them with a P11D if they've left for the value of the benefit since they've left. Obviously, up to the time they've worked, yes, you can payroll the benefit, you can do a P11D for them, but afterwards you need to think of how can that be reported. And one of the things the government have published is about the fact that it might be on the full payment submission as a payment for someone who's leaving. So you'd be looking at doing that as you would do for any kind of payment, albeit this is a notional payment.
Wow, it would be amazing, wouldn't it, if we all had payroll systems that could deal with all of this kind of stuff. And I guess in my experience, and I'm sure this is true for you as well, that payroll systems can take quite a while to catch up, particularly, I guess, if, as you've said, there's still some decisions that HMRC need to make, and we need to see that guidance. And especially if they're not UK-based systems, it's not so relevant. Do you think we could see lots of spreadsheets whizzing around? And what would you do about that?
I think we will see lots of spreadsheets whizzing around. I mean, I know AI is on the march at the moment across the world, and particularly in the UK, and it's being talked about a lot in tax. But I do think to get to grips with it manually, we will see people with spreadsheets to reconcile things during the year and post year end. It may be that the people have got quite an efficient and technological approach to that. But yes, in my terms, a spreadsheet would still be quite useful here, especially at the start of it, to make sure you've kept yourself mean and lean and clean with the tax compliance here, and to make sure you've not dropped the ball anywhere across the various stakeholders that will be involved in a process of implementing this and then keeping you compliant going forward. You will also need to just check your pay types through the payroll system, where you've got your governance documents. Should HMRC come and review this, can they see that you've got a policy, a process, who's ultimately accountable and responsible for this, and what people's roles are throughout this process internally? If you're ticking those boxes, it's going to be a much better way of demonstrating reasonable care than if you've just kind of got some pay types, but you're not really sure what you're doing with them, and you might check things, but no one's really clear on whose role that is. So it's really important to kind of get that built into your tax risk manuals and processes and procedures. Most organisations will probably pick this up as part of their payroll or HR process.
It's obviously a phenomenal amount to think about. So if you were in-house and you wanted to take some actions right after this podcast, other than obviously calling you, what would you do?
I think my first role would be to do a bit of a review of the historic position related to what benefits we offer. Have we taxed them correctly? Have we reported them? And what communications do we have that goes out to employees to tell them about it? I'd then think, secondly, well, what benefits are we looking at implementing going forward? And are they taxable, or are they exempt from tax? Are they reported somewhere else? So that's the starting point. You'd identify your stakeholders, so payroll, IT, tax, finance, operations, legal potentially too, get them round the table, and you'd agree a time plan. So if we're thinking we're not going to implement it until it goes live on a mandatory basis, when you don't really need to, you don't need to do anything, it'll just go live. So you've got till April 27. We've got a bit of time till then, but you really want to make sure you've got your milestones in place. So if you're thinking about going live from the April 27 payroll run, your cut-off for that will probably be around the 10th or 12th of April, I would imagine, in April 2027. So when do you need to have your pay type set up? You need to make sure that's done before then. You need to make sure you've then communicated that a couple of months at least in advance, so employees can get to grips with it, if not before, say, Christmas 2026. So employees are aware this is coming and you can have those discussions. And you'll have wanted to, before you have those discussions, to say we're now in kind of this time next year, September 26, you'd want to be making sure you've really confirmed and finalised all your key decisions. So if I'm going from backwards to forwards, you probably want to have started your process probably from at least the start of the 2026 calendar year to get those ideas, discussions and thoughts in play. And by then we'll have gone through the budget in 2025, so we may know a little bit more from that, because that's going to be a really important budget. And the government have published that they are looking to come back on some of the queries and concerns that have been raised by winter 2025. So that would be a good starting point to at least have that initial kick-off meeting, perhaps hold some workshops for training and to do those reviews as well. So that would be my advice to people and my kind of plan if I was in that position.
Brilliant. Well, Ian, thank you so much for sharing your insights today. I'm sure many listeners are already planning to call you. How can they reach you?
Easily, if they live in Halifax, probably come knock on my door.
Oh.
If not, they can reach out to me on LinkedIn. I'm on there and I respond to people regularly. You can obviously contact me through the Forvis Mazars website. All my contact details are on there, and happy to share any emails or phone numbers as appropriate with people if they've got any questions.
Brilliant. Thank you. And of course, if it's a wider question on, employee benefit strategy, then the Reward Heads team are always very happy to help. So thank you very much. It sounds like it's one to keep an eye on.
Thank you, Victoria. Really appreciate you giving me the opportunity to talk about this, and really nice to talk to you today.
Thank you.